Global diversification is known as being beneficial to you, the investor. But for it to really be beneficial, you need to understand how the foreign withholding tax works and how it can interfere with getting you the best returns on your investments. Hi, my name is Darius Muika, a senior investment advisor with Noor Private Wealth. If you are new to my channel, we focus on helping clients build wealth in the most tax-efficient way possible. In today's video, I'll briefly explain what is Level 1 and Level 2 of foreign withholding tax and what type of investments should you hold in certain account types versus others in order to avoid paying unnecessary taxes. So let's jump right in. When a Canadian investor collects on a dividend from a foreign country, that country's government mandates a tax on the dividend. The amount deducted in taxes all depends on the agreement made between the two countries. To put this into perspective, imagine that you, a Canadian resident, has dividends with a US company. The US government will keep 15% of your dividends. And since these taxes are deducted before you receive your dividend, it's quite easy to not even notice. Foreign withholding tax can do significant damage to your returns if they're not properly managed. The last thing you want is to find yourself paying a higher fee in unnecessary taxes than the management expense ratio on your mutual funds or ETFs. There are three main categories you'll come across when dealing with ETFs. A US listed ETF, a Canadian listed ETF that becomes known to the market by holding a US listed ETF, and 3, a Canadian listed ETF that becomes known to the market by holding stocks directly. Depending on how your ETF was created, you may encounter two types of withholding tax known as Level 1 and Level 2. Level 1 is used on dividends paid to a Canadian investor by any foreign country. Level 2 is used by the US government on dividends paid to a Canadian investor by a Canadian listed ETF that owns a US listed ETF. This tax equals to an additional 15% deduction. Taxes are deducted from your share when the dividend is paid from a foreign company to a US listed ETF. This repeats when the US listed ETF transfers the dividend to a Canadian investor. Okay, now a few things to keep in mind about account types and why they matter. Because of the Canada-US tax treaty, US funds held in an RRSP, RRIF or LIRA account won't have any US tax withheld on your dividends. A US listed ETF of US stocks won't have any tax withheld on dividends paid on an RRSP account. The same rule does not apply to TFSA and RESP accounts. This arrangement only applies to Canadian investors who invest in US funds. So any international stocks, regardless of account type, will be subject to foreign withholding tax on dividends paid. Remember, reporting withheld foreign taxes on your T3 or T5 will be beneficial in offsetting your Canadian taxes. This makes your money recoupable. However, in a registered account, there are no T-slips, so the foreign tax you pay ends up being lost and can't be used to offset your Canadian tax. Every type of investment account has the potential to save you a lot of money in the long run, so it's in your best interest to learn which types of ETFs to use. To recap, to avoid paying any foreign withholding tax, you can purchase a US listed ETF that holds US stocks in your RRSP. To purchase a US listed ETF, you need US dollars, which comes with a cost of conversion, so you'll need to decide if reducing your foreign withholding tax outweighs the cost of obtaining US dollars. You can reduce the cost of currency conversion by using a technique called Norbert's Gambit. A quick Google or YouTube search can walk you through it. Another option is to hold a Canadian listed ETF of US stocks in your RRSP. This will leave you with a 0.25% foreign withholding tax, or in other words, 0.25% in lost money. Holding a US listed ETF of US stocks in your TFSA account will also result in lost money of about 0.25% per year. When we expand outside of the US, level 2 withholding tax comes into play, which again is the taxes withheld by both the foreign country outside of the US and the taxes withheld by the US. A big offender for level 2 withholding tax is a Canadian listed ETF that owns US listed ETF of international stocks, held within a TFSA or RESP account. There are two levels of foreign withholding tax applied here, and neither of them is recoupable. So now that you have all this great info, what do you do with it all? Optimizing which assets should be held in which account types to minimize foreign withholding tax is a strategy known as asset allocation. Interested in learning how it's done? Stay tuned for my next video. That's it for today's video. I hope you found it valuable, and if you haven't done so already, make sure to hit the like button, and if you want to see more, don't forget to subscribe. If you have any questions or comments, please let me know below. I read and reply to every single one. Thank you very much for watching, and I will see you next time.